Breaking news is ripping through the US auto market right now, and it is coming from a company that almost never panics, almost never discounts aggressively, and almost never blinks first. Toyota has just dropped a bombshell, rolling out massive truck discounts that are already shaking dealers, competitors, and buyers across the country. This is not a routine seasonal incentive, and it is definitely not business as usual. When Toyota, the king of pricing discipline, starts cutting deals on its trucks, it signals that something much bigger is happening beneath the surface of the entire auto industry. So why is Toyota suddenly giving discounts now after years of rock-solid pricing power? The answer starts with inventory pressure and market saturation. For the first time in years, Toyota truck lots are filling up faster than they are emptying. Production has stabilized, supply chains have normalized, and trucks that were once impossible to find are now sitting longer on dealer lots. At the same time, high interest rates are squeezing buyers, monthly payments are scaring off even loyal customers, and demand is no longer keeping pace with supply. Toyota is not reacting out of weakness, it is reacting out of strategy, choosing to move metal now rather than let inventory age and force deeper cuts later. The discounts are not random, and they are not across every model. Toyota is targeting specific trucks where competition is fiercest and buyer resistance is growing. The Tacoma, one of America's most popular mid-size pickups, is seeing some of the most aggressive incentives, especially on outgoing trims and higher-priced configurations. Full-size Tundra models are also being included, particularly versions that sticker well above what average buyers are now comfortable paying. In some regions, dealers are quietly stacking factory incentives with dealer-level discounts, creating deals that would have been unthinkable just a year ago. What really matters is what is behind these discounts, and the reason goes far beyond Toyota alone. The entire truck market is facing a reality check. Prices ran too far, too fast, and buyers are finally pushing back. Financing costs have exposed just how stretched truck pricing has become, and even brands with legendary reliability like Toyota are not immune. Toyota sees the warning signs early, and instead of waiting for a demand cliff, it is choosing to stimulate sales proactively, protect market share, and keep dealers healthy while competitors hesitate. Now let's talk numbers, because this is where buyers start paying attention. While exact figures vary by region and trim, Toyota truck discounts are reportedly reaching several $1,000s on select models. Combined offers can include direct cash incentives, special financing rates, and dealer markdowns that together can significantly reduce the out-the-door price. For a brand that historically offered minimal incentives, even a few $1,000s represents a major shift, and in some cases, buyers are seeing deals that rival or beat incentives from traditionally discount-heavy rivals. The big question every buyer is asking is simple: should you buy now? For many shoppers, the answer is yes, but with strategy. If you have been waiting for Toyota trucks to become more affordable, this is one of the strongest buying windows in recent years. However, buyers should focus on models and trims that are clearly being incentivized rather than assuming every Toyota truck is suddenly cheap. Negotiation leverage has returned, and informed buyers can extract real value, especially if they are flexible on color, trim, or features. What truly makes this moment explosive is the impact on competitors. Toyota's move puts enormous pressure on Ford, GM, Ram, and even Nissan. When Toyota discounts trucks, it forces rivals to respond or risk losing buyers who cross-shop aggressively. This can trigger a chain reaction, where one incentive leads to another, and suddenly the entire truck segment enters a pricing battle. Dealers feel it immediately, competitors feel it within weeks, and the market as a whole starts to reset expectations about what trucks should actually cost. And here is where things get even more interesting, because if Toyota is willing to sacrifice margin now to defend volume and loyalty, it raises serious questions about how long competitors with weaker balance sheets can hold the line, how much further prices might fall, and whether this is just the beginning of a much larger shift in the US truck market, especially as buyers grow more cautious, inventories continue to rise, and the gap between sticker prices and real-world affordability becomes impossible to ignore. Because once Toyota moves, the rest of the industry is forced to confront realities they have been trying to delay. Truck pricing across the US has been built on the assumption that buyers would absorb higher costs indefinitely, but Toyota's discounts are exposing the cracks in that logic. Dealers are already reporting slower foot traffic, longer days on lot, and rising incentive conversations that were rare just months ago. Toyota is effectively signaling that the era of effortless truck sales is over, and the companies that adapt first will survive the reset with the least damage. Another critical factor behind Toyota's decision is competitive pressure from within its own lineup and from overseas brands. Newer redesigns, incoming model updates, and aggressive offers from rivals have created a narrowing window where Toyota needs to keep attention locked on its current trucks, rather than allow shoppers to drift toward discounted domestic pickups or emerging value-focused alternatives. Toyota is pulling buyers back into its ecosystem with pricing that finally feels realistic again. This is not desperation, it is calculated timing. For buyers watching from the sidelines, the psychology of the market has changed. When a brand like Toyota discounts, it gives permission to negotiate everywhere else. Buyers walk into dealerships more confident, more informed, and far less willing to accept take it or leave it pricing. Sales managers know this, which is why more flexibility is appearing behind the scenes. Even if window stickers have not fully caught up yet, the leverage has shifted and Toyota helped push that shift into motion. The ripple effects are already spreading beyond just trucks. Used truck values are starting to feel pressure as new models become more affordable. Trade-in offers are being reevaluated, and leasing math is changing fast. Toyota's move compresses the gap between new and used, forcing the entire pricing ladder to adjust. This matters because trucks sit at the top of the profit pyramid for many automakers, and any disturbance there sends shockwaves through the rest of the business. Competitors now face an uncomfortable choice: match Toyota's discounts and risk margin erosion, or hold pricing and risk losing buyers who are suddenly comparing numbers more aggressively than ever. For brands already relying heavily on incentives, this becomes a race to the bottom. For brands that resisted discounting, Toyota's move undermines their premium positioning. Either way, the pressure builds and the market inches closer to a broader correction. What makes this moment especially important is that it is happening while interest rates remain elevated. Automakers cannot rely on cheap financing to mask high prices anymore, which means the only real lever left is price itself. Toyota pulling that lever sends a clear message that affordability is back on the table, whether the rest of the industry is ready or not. And as buyers respond, competitors will have to decide how much pain they are willing to absorb to keep trucks moving. This is why industry insiders are watching Toyota's next steps so closely, because if these discounts expand, deepen, or spread to additional trims and regions, it could mark the start of a full-scale price realignment across the US truck market, one that reshapes dealer strategies, consumer expectations, and profit models in ways that will not be easily reversed. And the timing of this could not be more critical. The US auto market is entering a period where patience is wearing thin on both sides of the showroom. Buyers are tired of inflated prices, and dealers are tired of carrying expensive inventory that does not move fast enough. Toyota's discounts are acting like a pressure valve, releasing tension that has been building for years. By moving first, Toyota gains control of the narrative and positions itself as the brand that is listening, while others appear stubborn or out of touch. Another layer to this story is Toyota's long-term play. The company understands that loyalty in the truck segment is not just about horsepower or features, it is about trust. When buyers feel a brand is fair during tough economic times, that memory lasts far longer than any temporary discount. Toyota is betting that today's incentives will translate into tomorrow's repeat buyers, service customers, and brand advocates. That kind of loyalty is worth far more than squeezing out maximum profit on a single sale. Dealers, however, are walking a tightrope. While discounts help move inventory, they also reset expectations. Once buyers see lower prices, it becomes harder to push them back up. Toyota dealers must balance volume with margin, especially as nearby competitors begin reacting with their own offers. In many regions, this is already turning into a localized pricing battle, with trucks becoming the focal point of dealer-to-dealer competition. There is also a warning embedded in Toyota's decision that many people are overlooking. If the strongest, most disciplined automaker in the world is discounting trucks, what does that say about weaker brands that are already leaning heavily on incentives just to survive? For some automakers, this could accelerate financial strain, dealer closures, or deeper restructuring. Toyota can absorb thinner margins, not everyone else can. From a buyer's perspective, this moment rewards preparation. Understanding which Toyota truck models are discounted, how incentives stack, and how dealer inventory levels vary by region can mean the difference between a decent deal and a truly exceptional one. Buyers who rush in without research may still overpay, while those who wait too long could miss the sweet spot if incentives shift or inventories tighten again. And this is where the story continues to evolve, because Toyota's move may not stop with trucks. If sales data shows strong response, pressure will build to extend similar strategies to SUVs or crossovers, especially in price-sensitive segments. That possibility affordability alone keeps competitors on edge and forces analysts to rethink forecasts that assumed pricing would remain elevated well into the future. The bigger question now is not whether Toyota's discounts matter, but how far this shockwave will travel. Will it remain contained within the truck segment, or will it spill into the broader market and permanently change how Americans think about vehicle pricing, affordability, and negotiation power in a post-shortage, high-interest rate world? Because once buyer psychology shifts, it rarely goes back to the old baseline. The last few years trained consumers to accept sky-high prices and limited choice, but Toyota's discounts are retraining the market in the opposite direction. Shoppers are no longer asking if discounts exist, they are asking how big they are and how far dealers will go. That subtle change in mindset is powerful, and Toyota knows exactly what it is doing by triggering it now. Another consequence unfolding quietly is how this affects future model launches. When current generation trucks are discounted heavily, it forces automakers to rethink how they price upcoming redesigns. If buyers get used to seeing thousands off a Tacoma or Tundra today, it becomes much harder to justify aggressive pricing tomorrow. Toyota may be sacrificing short-term pricing authority to protect long-term volume stability, especially as competition intensifies and alternative powertrains continue to enter the market. This also reshapes negotiations at the dealership level. Sales staff who once held firm are now reopening conversations they avoided for years. Fees, add-ons, and markups that were once non-negotiable are suddenly on the table. Toyota's move weakens the entire industry's ability to rely on artificial scarcity, and once that illusion breaks, it is extremely difficult to rebuild. Meanwhile, suppliers and lenders are watching closely. Lower transaction prices ripple backward through the supply chain, affecting everything from parts contracts to residual values. Leasing companies must adjust assumptions, and banks reassess risk as market pricing becomes more fluid. Toyota's discounts do not just impact showrooms, they influence the financial machinery that supports the entire auto ecosystem. For competitors, the pressure is relentless. Ford, GM, Ram, and others now face buyers walking in with screenshots, quotes, and expectations shaped by Toyota's pricing. Refusing to respond risks losing conquest sales, while matching the discounts erodes profitability. This is the kind of squeeze that forces hard decisions, especially for brands already struggling with rising costs and slower demand. What makes this moment especially volatile is that it is unfolding unevenly across the country. Some regions are seeing deeper Toyota discounts than others, creating pockets of intense competition and price discovery. As word spreads online and through social media, those regional deals influence national perception, even if not every buyer can access them immediately. And all of this builds toward a critical inflection point. Either the industry adapts to a new, more price-sensitive reality, or it continues to resist and risks a sharper correction later. Toyota's discounts are not just about clearing inventory, they are about shaping what comes next, setting expectations, and quietly forcing the rest of the market to follow whether they want to or not. And as this unfolds, industry analysts are starting to connect the dots between Toyota's move and broader economic signals. Consumer confidence is uneven, household budgets are under strain, and discretionary spending is being scrutinized more carefully than at any point in recent years. Trucks, once seen as must-have lifestyle vehicles, are now being evaluated like major financial commitments. Toyota's discounts acknowledge this shift and meet buyers where they actually are, not where automakers wish they were. There is also a strategic defensive angle here. Toyota has built its reputation on durability, reliability, and long-term value, but value is meaningless if the entry price becomes unreachable. By lowering the barrier now, Toyota protects its brand image as attainable rather than exclusive. That distinction matters in a market where buyers are increasingly willing to walk away rather than stretch themselves financially. At the same time, the discounts are creating internal pressure across dealer networks. High-volume dealers are moving trucks faster and gaining momentum, while smaller or less aggressive stores risk being left behind. This creates a natural consolidation effect where pricing transparency and competitiveness become survival tools rather than optional strategies. Toyota's corporate decision cascades all the way down to individual sales desks. For buyers still undecided, the fear of missing out is now working in the opposite direction. Instead of rushing rushing to buy before prices rise. Shoppers are waiting to see how low they can go. That reversal in urgency is dangerous for automakers, and Toyota's willingness to tolerate it suggests confidence in its balance sheet and long-term planning. Few companies can afford to play this game. Toyota can. The longer these discounts remain in place, the harder it becomes for the market to argue that high prices were justified by demand alone. The narrative shifts toward correction, not collapse, but a correction that could last longer and cut deeper than many expect. Trucks have been the profit backbone of the US auto industry, and any sustained pressure there reshapes everything from product planning to advertising budgets. What is happening right now feels less like a temporary promotion and more like a recalibration. Toyota is not shouting about desperation, it is quietly resetting expectations while competitors scramble to interpret the message. Buyers sense it, dealers feel it, and rivals cannot ignore it. And as inventories, incentives, and buyer behavior continue to evolve week by week, the question is no longer whether Toyota's bombshell matters, but how this chain reaction will redefine the truck market as we move closer to a point where affordability, not hype, becomes the dominant force driving every decision made across the US auto industry. Because once affordability becomes the central theme, everything else takes a back seat. Features, branding, even long-standing loyalty start to bend when numbers finally make sense again. Toyota's discounts are accelerating that shift, forcing buyers to reevaluate not just what they want, but what they are willing to pay. This is a fundamental change in how trucks are being judged, and it places enormous pressure on manufacturers that built their strategies around perpetual price escalation. Another underappreciated impact is how this affects future trade-ins and ownership cycles. Lower new truck prices today influence residual values tomorrow, which means owners planning to upgrade in a few years may see different equity outcomes than expected. Toyota understands this risk, but it is choosing to manage it now rather than allow the market to unravel unpredictably later. That level of foresight is what separates reactive discounting from controlled market steering. Inside the industry, conversations are shifting from growth to resilience. Automakers are no longer asking how high prices can go, but how flexible they need to be to maintain relevance. Toyota's move reframes the competitive battlefield, making adaptability the key advantage. Those who cling to old assumptions risk being caught flat-footed as buyer behavior evolves faster than pricing strategies can adjust. Dealership dynamics continue to change as well. Sales teams are retraining, marketing messages are being rewritten, and digital pricing transparency is becoming unavoidable. Toyota's discounts make it harder for anyone to hide behind vague incentives or inflated MSRPs. Clear numbers are winning attention, and clarity builds trust at a time when skepticism runs high. For competitors, this moment is deeply uncomfortable because it removes the luxury of delay. Waiting for interest rates to fall or demand to magically rebound is no longer a viable strategy when Toyota is actively pulling buyers toward more rational pricing. Every week that passes without a response risks lost market share that may never fully return. And yet, this story is still unfolding. Incentives can change, inventory levels can tighten, and economic conditions can shift. But the signal Toyota has sent cannot be unsent. The market has seen that even the most disciplined automaker is willing to bend when conditions demand it. What happens next depends on how far this recalibration goes, how aggressively competitors respond, and whether buyers continue to hold the line for better deals. The truck market is at a crossroads, and Toyota has just nudged it in a direction that prioritizes realism over hype, value over bravado, and long-term stability over short-term illusion. And that shift toward realism is exactly why this moment matters so much more than a headline about discounts. It represents a reset in how power is distributed between automakers, dealers, and consumers. For years, manufacturers dictated terms, dealers enforced them, and buyers adapted. Toyota's decision subtly disrupts that hierarchy, giving consumers more influence at the negotiating table and forcing the industry to acknowledge changing economic conditions. There is also a competitive signaling effect at play. When Toyota moves first, it sends a message not just to buyers, but to Wall Street suppliers and global partners. It signals confidence in volume, confidence in efficiency, and confidence that the company can weather thinner margins better than most. That kind of signal can rattle competitors who rely on higher per unit profits to stay afloat. As weeks pass, data will begin to reveal the true impact. Sales velocity, incentive spending, and dealer throughput will show whether Toyota's strategy is working as intended. Early indicators suggest that buyers buyer interest is rising, but the real test will be sustainability. Can these discounts maintain momentum without triggering a race to the bottom? Toyota appears willing to walk that line carefully, adjusting region by region rather than detonating prices nationwide all at once. For consumers, this creates an unusual window of opportunity. Timing, research, and patience matter more than ever. Buyers who understand the broader forces at work can approach dealerships with confidence, knowing the market is no longer tilted entirely against them. Toyota's move has cracked the door open. How far it swings depends on how aggressively buyers push. Meanwhile, competitors are being forced to reconsider long-standing assumptions about brand insulation. The idea that loyalty alone could protect high prices is being tested in real time. As Toyota offers compelling deals, it exposes how thin the line really is between premium perception and price resistance. All of this builds toward a market that feels more dynamic, more competitive, and far less predictable than it has been in years. The calm, orderly pricing environment of the recent past is giving way to a phase of adjustment where strategies are tested weekly, not annually. And as this adjustment continues, every new incentive, every inventory report, and every dealer-level decision adds another layer to a story that is still gaining momentum, with consequences that could extend well beyond trucks and into the very structure of how vehicles are priced and sold across the United States. And beneath all of this, there is a quiet urgency building that few automakers want to acknowledge publicly. The longer trucks sit on lots, the more expensive they become to carry, especially in a high interest rate environment. Floor plan costs are rising, cash is tied up, and pressure mounts behind the scenes. Toyota's discounts ease that pressure before it becomes visible to consumers in more damaging ways, such as abrupt price collapses or abrupt production cuts. This also reframes how buyers interpret value. For years, value was justified by scarcity and brand reputation. Now, value is being recalculated in monthly payments, total cost of ownership, and realistic resale expectations. Toyota's move aligns with that recalibration, reinforcing its image as a rational choice rather than an aspirational stretch. That positioning could prove decisive if economic uncertainty lingers longer than expected.